Good afternoon, everyone. Now, it's probably not the first time you've heard this, but I feel I've been a little bit of a victim of a bait and switch here. That this is advertised as the B.E.E.R lunch, and well, anyways, maybe I'll have to come back in October. Good afternoon, everyone, and thank you very much for the invitation to join you here today. It's a pleasure to be here and to share my thoughts on the prospects for the economy and the role of monetary policy going forward. But as you will hear in a minute, I'm also interested in your thoughts on the state of the economy and on your questions about Federal Reserve policy. So I very much look forward to our discussion following the talk. In my remarks today, I'll be providing some background about the Federal Reserve. I'll then describe the current stance of monetary policy in the United States. I'll discuss the macroeconomic outlook for the next couple of years implied by that stance of monetary policy. And then I'll offer my assessment of the appropriateness of monetary policy in light of that macroeconomic outlook. But first, a disclaimer. As you'll hear shortly, I'm one of the 19 people who have the privilege and honor to participate in the meetings of what's called the Federal Open Market Committee. The FOMC meetings shape the course of monetary policy in the United States. But it's very important to understand that my remarks today are only my views and not necessarily those of any other FOMC participant. Let me begin with some basics about the Federal Reserve System. I like to tell people that the Fed is a uniquely American institution. What do I mean by that when I say it? Well, relative to its counterparts around the world, the U.S. central bank is a highly decentralized one. The Federal Reserve Bank of Minneapolis is one of 12 regional reserve banks that, along with the Board of Governors in Washington, D.C., make up the Federal Reserve System. Our bank represents the 9th of the 12 Federal Reserve districts, and our district includes Montana, the Dakotas, Minnesota, northwestern Wisconsin, and the Upper Peninsula of Michigan. 8 times per year, the FOMC meets to set the path of short-term interest rates over the next 6 to 7 weeks. All 12 presidents of the various regional Federal Reserve banks, including myself, and the 7 governors of the Federal Reserve Board contribute to these deliberations. But the committee itself only consists of the governors, the president of the Federal Reserve Bank of New York, and a rotating group of 4 other presidents. So, for example, I'm not on the committee this year, but I will be next year in 2014. In this way, the structure of the FOMC mirrors the federalist structure of our government, because representatives from different regions of the country, the various presidents, have input into FOMC deliberations. Congress requires the FOMC to make monetary policy so as to fulfill 2 mandates: to promote price stability and to promote maximum employment. I think it should be clear that these are both Main Street objectives. Promoting maximum employment means that the Fed is charged with doing what it can to ensure that Americans who want to work can do so. Promoting price stability means the Federal Reserve is charged with keeping inflation close to a pre-specified target. Price stability ensures that when people write contracts in terms of dollars that are going to be paid off in the future, so here I'm thinking about things like loans, student loans, annuities, anything like that. When people write contracts in that form, they can have certainty about what those dollars they're going to be getting or paying will be able to buy in the future. Now, in describing price stability, I've made reference to a pre-specified target for inflation, and I didn't say what that pre-specified inflation target is. In choosing its inflation target, the FOMC weighed the costs of overly high inflation against the need to guard against potentially destructive deflationary spirals. And this assessment has led the FOMC to choose a target for inflation of 2% per year. Similarly, most central banks around the world have opted for a low but still positive inflation target. So those are the 2 mandates: to promote price stability and to promote maximum employment. How do we go about trying to achieve those mandates? The FOMC acts to achieve its 2 mandates by influencing interest rates through the purchase and sale of financial assets. when the FOMC raises interest rates, households and firms tend to spend less and save more. This fall in spending puts downward pressure on both employment and prices. Similarly, when the FOMC lowers interest rates, households and firms tend to spend more and save less. And this puts upward pressure on employment and prices. Now, one of the challenges we face in doing this is that these pressures I've described from low interest rates into employment and prices are not instantaneous. They're not felt immediately. Instead, it typically takes a year or two for the effects of monetary policy adjustments to manifest themselves in inflation and unemployment. This means that the FOMC's decisions about appropriate monetary policy necessarily hinge on the members' forecasts of the evolution of prices and employment over the next year or two, what we typically would call our medium-term outlooks for inflation and unemployment. So I'll come back to this, and I'll be talk about the interaction between my outlook and appropriate policy later in my remarks, and it will be really a core feature of what I have to say. So that's the background. We're trying to achieve maximum employment, promote maximum employment, and promote price stability through our influence on interest rates, and thereby influencing the level of economic activity and prices and employment. With that background, let me turn to talk about the current stance of monetary policy. The change in monetary policy over the past 5 years has been dramatic. At the end of 2007, the Federal Reserve had less than $900 billion of assets, and they were mostly in the form of short-term treasuries. It was targeting a Fed funds rate, short-term interbank lending rate, of over 4%. So that was at the end of 2007. As of now, early 2013, the Federal Reserve owns over $3 trillion of assets, mostly in the form of long-term government-issued or government-backed securities. The Fed is currently targeting a Fed funds rate of under 0.25%. Now, as I sketched for you earlier, both of these changes in the stance of policy are designed to put upward pressure on employment and prices. In particular, the near-zero Fed funds rate pushes downward on the interest rate that businesses and households can earn by saving money, and downward on the interest rate that they have to pay to borrow money. These low interest rates encourage households to consume today rather than saving to consume in the future. Similarly, firms are encouraged to engage in capital expenditure rather than saving. This higher demand for consumption on the part of households and investment on the part of firms pushes upward on both prices and employment. Similarly, the Fed's holdings of long-term assets mean that the private sector as a whole is less exposed to the interest rate risk that's embedded in long-term investments. As a result, some private investors will demand a lower premium for holding other bonds that are exposed to interest rate risk, and that puts downward pressure on long-term yields. And again, faced with these low long-term yields, households and businesses should be more willing to spend now rather than later. So, in going through this, I've been describing the Fed's current policy actions. But the impact of monetary policy on the macroeconomy really depends critically on the private sector's beliefs about the Fed's future actions. Not what it's doing right at this moment, but what it's going to be doing in the future. I'll take an obviously hypothetical extreme. Suppose the private sector believed today the Fed would return permanently to its 2007 policy stance by June, at the June meeting. Then the macroeconomic impact of the Fed's highly accommodative stance over the next couple of months before that June meeting would be negligible. For this reason, the Federal Open Market Committee has gone to great lengths to provide what's called forward guidance, communication to the public about the likely future evolution of its monetary policy decisions. So right now, the committee is buying $85 billion of long-term assets each month. It's provided forward guidance about its future plans for asset purchases by saying it intends to continue these asset purchases until there is substantial improvement in the labor market outlook. As Chairman Bernanke indicated in his recent press conference, the rate of these purchases may well vary in response to information about economic conditions. The committee has provided even more precision to the public about the likely future path of the Fed funds rate. In its December statement, the FOMC announced that it anticipated keeping the Fed funds rate at its current extraordinarily low level of between 0 and a quarter percent, at least until the unemployment rate fell below a threshold of 6.5%, as long as the medium-term inflation outlook remained below 2.5% and longer-term inflation expectations remain well anchored. The unemployment rate, as we'll talk about, is currently 7.7% as of February. And most private sector forecasters see the unemployment rate staying above 6.5% well into 2015. The FOMC's communication tells the public that it should expect the Fed funds rate to stay extraordinarily low over that same time frame, and possibly longer. I was delighted by the FOMC's decision to offer this degree of precision about its forward guidance. I think one important benefit of this kind of language, it tells the public how the stance of monetary policy will evolve in response to changes in economic conditions. So, for example, if the unemployment rate were to fall more slowly than expected and the inflation outlook remains subdued, the Fed funds rate will be extraordinarily low for a longer period of time. If the unemployment rate were to fall more rapidly than expected, the Fed funds rate will be extraordinarily low for a shorter period of time. In this way, the FOMC has assured the public that the stance of monetary policy will automatically adjust in an appropriate fashion to the evolution of macroeconomic conditions. And I think this automatic adjustment is an important benefit of the Fed's thresholds that I've described about for unemployment and inflation. I should be clear about a couple of aspects of these thresholds, the 6.5% unemployment threshold and the 2.5% medium-term inflation outlook threshold. First, the unemployment rate threshold is not a trigger for FOMC actions. So what I mean by that is, when the unemployment rate falls below 6.5%, the FOMC may or may not choose to raise rates at that stage. Second, I see the FOMC's guidance as providing a great deal of protection against undue inflationary pressures, in keeping with our price stability mandate that I mentioned earlier. In particular, the commitment to keep interest rates extraordinarily low is off the table if the medium-term inflation outlook ever rises above 2.5%. And remember, I said the Fed's target for inflation was 2%. So if we ever got that outlook that was just 0.5% above that target, then we would be, this commitment to keep rates low would be off the table. And I'll have more to say about this protection later in my remarks, this inflation protection later in my remarks. So I've described the Fed's current monetary policy stance in some detail, and I've emphasized that the Fed's stance is much more accommodative than it was 5 years ago. And that observation alone might suggest that the Fed's policy is too accommodative. But there have been big changes in the economy since 2007. Over the past 5 years, Americans have lost jobs and they've lost wealth, a great deal of wealth. Relative to 2007, people remain uncertain about future employment and income. Businesses, too, are less certain about the future demand for their goods. These changes, these uncertainties, they make firms and households less willing to spend than in 2007. And so these forces push down on both employment and on prices. In order to fulfill its dual mandate of promoting price stability and max employment, it's appropriate for the FOMC to adopt a more accommodative stance than it had in 2007. The right question we have to ask ourselves is a much more subtle one. Is the FOMC over-responding to the changes in the economy I've described since 2007 by providing too much accommodation? So I noted, as I talked about earlier, the impact of monetary policy on the macroeconomy unfolds only slowly over a year or two. So my answer to this question about whether the FOMC is providing too much accommodation or not depends on my outlook for how the economy is going to unfold over the next year or two. With that in mind, I'll turn now to describing that outlook, placed in the context of the evolution of the macroeconomy over the past 5 years. So I'll start by looking at the evolution of national output. And this is just measured by gross domestic product adjusted for inflation, so-called real GDP. This brown shaded area here is the time of the so-called Great Recession. It started at the end of 2007 and went through mid-2009. Real GDP was rising through 2007, dips down in 2008, but actually the first half of 2008 doesn't fall that much, but then of course really collapses precipitously in the latter portion of 2008 and into 2009. Since then we've been growing steadily, but we've been growing at close to the long-term historical average, actually slightly less than that since the end of the recession. But that usually after recessions we tend to grow faster than the long-run historical average, sort of to try to catch up to the trend line we were on before. So we're still well below what you would have forecast our path to be. If you had just been forecasting where real GDP was going to be in 6 years, or 5.5 years at the end of 2007, we're well below that. So this is why we've had a recovery. When economists say that we've been growing pretty steadily, this is, it's a little flat, but we view this as just a pause in economic activity, as I'll describe in a few minutes. Basically, we've been growing steadily, but the pace of the recovery has been moderate, slow, whatever term you want to use. Now, given that path for real GDP, you can see it's mirrored in what's happening on labor markets at the national level. What is sort of interesting is the unemployment rate actually starts to pick up in 2007 before the beginning of the Great Recession. Okay? So it's around 4.5%, 4.7% early part of 2007. By the end of 2007, it's up to 5%. And then, of course, the fall in real GDP I showed you earlier is mirrored in an enormous increase in the unemployment rate, a doubling of the unemployment rate, 5% to 10% in October 2009. The unemployment rate has basically been falling steadily since that time period. There's been some upticks, but largely I would say we've had a steady decline, and the unemployment rate is now at 7.7%, as I said earlier, as of February. Now, so this is all sort of focusing on the discussion of unemployment, especially is focusing on the maximum employment mandate that I talked about for the Federal Reserve. The Federal Reserve has also a price stability mandate to keep inflation close to 2%. So this is a chart showing the path of personal consumption expenditure inflation. It's a little different from the consumer price index you're usually used to hearing. It's a broader measure of goods and services the Fed likes to use for keeping track of inflation. One thing to highlight, though, is that this is what's called headline inflation as opposed to core. So it's got all the goods and services in it. It's not taking out food and energy goods. Sometimes you'll hear people take out food and energy, and I'll explain why they do that in a second. But this is everything. And when we talk about targeting inflation, we're targeting the rate of increase of prices of all goods and services. We're trying to keep that at 2%. And it has been a wild ride on the inflation front. So what I'm measuring here is year-over-year inflation, 12-month percentage change. Early part of 2008, inflation was running over 4%, 4.5%. Then it just collapses down to minus 1% in mid-2009. What's going on with that? This is why people get rid of energy. It's because this is all being driven by the price of oil. The price of oil spiked sharply in the beginning of 2008, and that feeds into consumer prices through gasoline, right? So gasoline prices spiked in the first half of 2008. Then the price of oil collapsed in the latter half of 2008 and into the first part of 2009, and that's mirrored in a very sharp reduction in the price of gasoline. It's not that gasoline is such a huge fraction of what we buy. It's a relatively large fraction, but boy, it moves around a lot. So if you're sitting here as a monetary policymaker at the beginning of 2008, if you try to forecast what's going to happen with inflation in the next year or two, and you're trying to use headline inflation, you're going to mess up, to use the technical term, all right? Because everything's going to be dominated by what's happening with food and energy, or primarily energy, I should stress. And you would have been wrong, dramatically wrong about what's going to happen to the overall price index. It's very important when you're thinking about the behavior of inflation to look over a broad range of goods and services and to be looking over a long enough time horizon as well. Now I look at the 5-year average, and actually the price level has been growing slowly relative to target, 1.6%. And we look right now, I told you to look over a broader, longer term horizon, it's right to do that. Right now, both core and headline are lower than 1.5%. So well below our target of 2 at this stage. So that's a brief review of the past 5 years. Real output's been recovering slowly. Unemployment remains well above 2007 levels. and inflation is averaged below the Fed's target. So let's see what's going to happen, what I think is going to happen. No guarantees that this is actually what's going to happen. And I have to say, I see more of the same coming. I see a continued ongoing recovery, but at a moderate rate pace. 2.5% growth in 2013, rising to around 3% in 2014. The long-run historical average I mentioned earlier would be somewhere between 2.5 to 3, so we're right around that long-run historical average. But that's slow relative to what we would really need to be making a lot of progress on the unemployment front. And you're going to see that reflected in my forecast for unemployment. I see unemployment falling to 7.5% by the end of 2013 and 7% by the end of 2014. So this is a very slow rate of decline. Finally, this high unemployment translates primarily into muted wage pressures, and that's going to translate into muted inflation as well. Inflation I see rising up to 1.6% from our current low level over the course of this year, and rising up to 1.9% over the course of 2014. So that's my outlook for 2013, 2014. Continued slow recovery, slow decline in unemployment, and gradual increase of inflation, but still remaining below target in 2014. How does this outlook influence my thinking about monetary policy? As you'll hear, my main conclusion from that outlook is that monetary policy is currently not accommodated enough. Now, why do I say that? Well, the FOMC has a 2% inflation target. I do see inflation eventually returning to 2% under the FOMC's current stance. But it's a slow rate of progress. As I've said, I anticipate that inflation is only going to be 1.6 and 1.9 in 2014. The FOMC could get back to target faster, better promote price stability as is mandated by Congress by adopting a more accommodative monetary policy stance that puts upward pressure on prices. So this is only looking at inflation. I think the argument is even more compelling if you look at unemployment. We have a second mandate, which is to promote max employment. Most of the 19 FOMC participants believe the unemployment will converge to a level between 5.2 and 6% within 5 to 6 years. But under the current formulation of monetary policy, as you can see, I expect that rate of convergence to that long-run desirable level to be slow. So I expect unemployment to still be 7% at the end of 2014. The FOMC could facilitate a faster return of unemployment to its long-run level by adopting a more accommodative stance. So I would say that both my outlook for unemployment and my inflation point to a need for more accommodation. Now, based on, I've talked about needing more accommodation. How can the FOMC provide more accommodation? I think there are several possible approaches open to the committee. The committee could reduce the public's level of uncertainty, policy uncertainty, by clarifying the nature of the economic conditions that would lead the committee to reduce or stop its current asset purchases. As I mentioned earlier, the committee is buying $85 billion per month. What would lead it to stop or reduce that flow of purchases? Alternatively, the committee could communicate to the public that once we do begin the removal of monetary accommodation, which is still a long ways off, the rate of withdrawal, when it starts to take place, will be slower than is currently anticipated. Both of these would provide accommodation for the economy, be monetary stimulus. But these are going to require some relatively complex changes in the language of the current communication from the committee. My own preferred approach is simple. In its current forward guidance, as I told you, the FOMC has said it's going to keep the Fed funds rate at extraordinarily low levels till unemployment falls below 6.5%. You can provide additional stimulus by changing that 6.5% number to 5.5%. So it's just changing one number in the current statement. Now, why is changing that one number from 6.5 to 5.5 going to provide more stimulus to the economy? Well, think about two scenarios. One in which the public believes the FOMC will begin raising the Fed funds rate when the unemployment rate hits 6.5. That's consistent with the current guidance. And the other, the public thinks the FOMC will wait till 5.5. A higher unemployment rate in the first scenario means that the public will think that monetary policy is going to be tightened relatively soon. And that's going to in turn lead to the unemployment rate being higher for longer. People are going to have to save more in that scenario to protect themselves against the risk of being unemployed. They save more, they spend less, there's less economic activity. Lowering the unemployment rate threshold to 5.5% would increase the demand for goods and thereby push upward on both employment and prices. So I think the big question, though, about this is, would this extra monetary stimulus result in an undue amount of inflation at some point in the future? And here I find the recent historical evidence to be quite comforting. This is the medium-term inflation outlook coming out of the FOMC. The green portion comes out of what's called the Green Book, which is a staff forecast for inflation that they prepare for FOMC meetings. The SEP is a summary of economic projections. These are based on projections that are come out of the principals of the meeting, the FOMC participants, the 19 participants I described earlier. And those projections will only be started being made actually in 2007, which is why we start that picture in 2007. And earlier, those are as I said, the Green Book forecasts are coming out of staff forecasts. If you look at this chart, it documents that the medium-term inflation outlook has never risen above 2.25% in the past 15 years. And this is even though the unemployment rate, as I showed you earlier, was actually at times below 5%, actually closer to 4.5% at times. This historical evidence, to me, suggests that as long as the unemployment rate remains above 5.5%, wage pressures will be sufficiently subdued that the medium-term inflation outlook will stay close to 2%. Okay, so this is using the past, right, to inform our guesses about the future, or our thoughts about the future. But I don't have a picture for this, but the committee's estimates of future long-run unemployment are also consistent with this historical evidence. Most FOMC participants expect over the long run an unemployment rate of between 5.2 and 6% is consistent with inflation of 2%. So that's, we can get to keep unemployment between 5.2 and 6% and not have inflation be different from 2. These estimates suggest that as long as unemployment remains above 5.5%, wage pressures will not be sufficiently strong to generate a medium-term inflation outlook, much in excess of 2%. Now, these are estimates based on what we know now about current labor market conditions. The FOMC's estimates of the unemployment rate consistent with max employment could change over time in response to new information and new analysis. This is why it's so important the FOMC's current forward guidance contains what I see as strong protection against inflation, undue inflation. As I described earlier, that guidance clearly states that the committee's commitment to a low Fed funds rate is off the table if the medium-term inflation outlook ever rises above 2.5%. I've said that I see it as unlikely that this inflation threshold will be breached. It's informed by these kinds of data analysis. Even if the committee were to lower the unemployment rate threshold to 5.5%. But the converse is also true. I would see a breach of this threshold as being a cause for significant concern. We haven't seen a medium-term inflation outlook as high as 2.25% over the past 15 years. In that context, a medium-term inflation outlook of 2.5% or more should be seen as highly unusual. In my view, such an unusually high inflation outlook should lead the FOMC to strongly consider an aggressive response. So to summarize, my outlook for both inflation and unemployment implies that the FOMC should provide more monetary accommodation. In December, the FOMC said that it anticipates keeping the Fed funds rate extraordinarily low at least until the unemployment rate falls below 6.5%. In my view, it would be appropriate for the committee to increase the level of monetary accommodation by lowering the unemployment rate threshold to 5.5%. You might be worried that this will give rise to undue inflationary pressures. I see that possibility as unlikely. And even if I'm wrong in my assessment, the committee's forward guidance provides tight inflation safeguards. Monetary policy, here I'll come to my conclusion. Monetary policy affects the economy with a lag of 1 or 2 years. So if a policymaker's views about the appropriate level of current monetary policy has to depend on his or her forecast of how the economy will evolve over the next year or two. My own outlook is that growth will remain moderate, I should say, over the next 2 years. As a result, under current policy, my outlook is that inflation will run below the Fed's target of 2%, and the unemployment will be above 7% over that same time frame of the next 2 years. The FOMC can better promote price stability, promote maximum employment, as mandated by Congress, by adopting a more accommodative policy stance. There's several ways the FOMC could provide that accommodation. In my remarks today, I've emphasized one that I see as particularly simple. The unemployment rate threshold in the current forward guidance could be changed from 6.5% to 5.5%. Thank you very much for listening, and I look forward to taking your questions.